Perfecto, ahora sí podemos comenzar. Nuevamente, buenas noches a todos y bienvenidos a un nuevo día aquí en DS4A Colombia. Esperamos que hayan disfrutado de las actividades de ayer. Conocer a nuestros compañeros de equipo ETAs es de vital importancia porque recuerden que ellos serán su mayor apoyo. El día de hoy seguiremos con nuestras lecciones. Tendremos nuevamente con nosotros al profesor Gavino, esta vez dictando un caso analítico. How are trading volume and volatility related for energy stocks? Esperamos aprendan y disfruten mucho. Welcome back, Professor Gavino. It's a pleasure to have you again with us tonight. And of course, the floor is all yours.
Muchas gracias, Mónica. Bienvenidos y bienvenidos a todos esta noche. Yo soy muy emocionado esta noche de enseñar a vos todos. Okay, let's start sharing my screen so we can start with our case. Okay, Firefox, share sound. Can you all see my screen?
Yes, we can see your screen, Professor.
Great. So if in the first class, remember, we started with some basic definitions about what is data science. We are attending a course called Data Science for All, but what is really data science? How related it is to machine learning, to artificial intelligence, and so on. And by the end of the class, I could tell that everybody was grasping really well these concepts, were asking me very interesting questions. So, well, today we are going to have our first taste of data. I think you have been playing with some data already earlier on today and yesterday, but this is the first time that we touch data together. And we are not there yet to see complex modeling and so on. So we're going to, the main topic of today's class is exploratory data analysis or descriptive statistics. That is a set of operations that we want to do, that we want to implement each time we open a new data set. For some of you, so the concepts that we are going to cover today might be a repetition because you might have encountered them already in other classes or in school and so on, but it's always good to revisit certain concepts. And so the more advanced of you, I ask you to be patient. You will have plenty of challenging material coming up your way. And so today we're going to start soft with something very simple, but that hopefully will provide also the connection to real world examples. So all the cases that we will present with correlation 1 are rooted in real world data, in realistic scenarios that for you as data scientists will be very common to encounter during your career. So today's business case has to do with finance, with trading stocks, and which is a very challenging and charming area. When I was a college student, it was actually my dream to work in Wall Street or at the city in London trading and so on. And I did a little bit of that, but then I realized that I liked studying even more. However, there is always a special place for financial applications in my heart. So this is the case for today. The business context. You are an analyst in a large mutual fund. Mutual funds are these big aggregators that invest in multiple shares, multiple stocks in different markets, okay? But this particular fund is focused on natural resource stock investments. Notice that here we are defining very closely the type of securities that we are considering. We are considering stocks, so not bonds, but stocks, parts of shares of these companies. And these companies are all focused on natural resources, on energy, to be more specific. Several of them are, traded in the US stock market. And why are they important? Well, our industries, they need natural resources in order to function. And Imagine that in recent times, there are 5 particular ones that you want to focus your attention, that your team is focusing on. The Dominion Energy, Exelon, NextEra Energy, Southern Company, and Duke Energy Corporation. So this particular sector is important, but is very volatile. What does it mean, volatile? Volatile, it means that the prices of these stocks tend to change a lot, within even the same day, or even within an hour, even within smaller periods of time. What does that mean? That the price can go up and down by a large margin. Conversely, there are other types of stocks that are much more stable, where the price does not change very much. Why, in a business context like this, we care about volatility? We care about volatility because the idea of volatility is closely connected to the idea of risk. So imagine that you have a price that goes up a lot and goes down a lot. It means that you can buy some of these shares very cheap, so when the price is low, and then you can sell them eventually when the price is very high and you make a big margin, you make a big profit. However, you can be also in the opposite case. You purchase some of these stocks when they're very expensive, and then the price drops. Oops, you lost a lot of money. In this sense, volatility and risk are strongly connected. So big risk means big rewards, potential, but also potential big losses. So understanding the volatility is a very, very important question for all traders and investors as well. In fact, I always recommend people, when they ask me, how should I build my portfolio to invest my savings? I would say, well, always focus your portfolio on stable type of securities, and perhaps invest in more risky securities, only the parts that you can afford to lose. So if you have most of your savings on, let's say, government bonds that are typically very, they don't change that much. They don't give you a big reward, but you don't lose your money if you invest, let's say, on government bonds. However, some stocks can be very volatile, and that's true also for derivatives or high-tech companies or startups. Startups are a particular example of this. Startups can be investments where you invest a small amount and you can end up earning a lot of money or just losing completely your investment. So the idea of risk is connected with the idea of reward. Now, suppose that your firm for which you're working on is very large. So you don't care just about volatility, but also you care about volume. That is, you want to make sure that the stocks that you trade, the volume is large enough so that if you decide that you don't want those stocks anymore, that you can actually sell them fast. Because if there's something that is very slow that nobody cares about, what happens is that you might be carrying in your portfolio some stocks that are very low value, but they might be hard to sell, and then the price might even go lower, and there are a lot of issues that get involved. So the goal today is to start investigating the relationship between the trading volume and the volatility for this particular set of energy stocks. Okay? So the business problem is the following. Given that both low trading volume and high volatility present risks to your investments, your team lead asks you to investigate the following question. How is the volatility of energy stocks related to their average daily trading volume? That is, you want to look at the volatility in relationship to the average daily trading volume. That is, you are measuring the trading volume over several days and you are calculating the average. And then you want to see if the stocks that have higher trading volume, how is their volatility? Is it just as high, or there is an inverse relationship, for instance? Okay. So in order to notice that we are following the approach of a data science problem. Although today we will not be doing predictions or anything fancy like that, we are starting with an hypothesis. The hypothesis that there might be a relationship between trading volume and volatility. And for this, what do? We acquire evidence, okay? Daniel comments, volume is related to liquidity. Exactly. Liquidity is the possibility of buying or selling any good, really, any type of product fast enough. What is the most simple example? What is the most liquid type of entity that you can trade? Currency, the money, exactly. Everybody does it, money, cash. Why is that? Because it has to be accepted legally, at least in an internal market. Now, if we are talking about trading currencies among countries, that's a different story. Nobody forces you to buy, currency from another country. But, in Colombia, you can use pesos to purchase everything. If it's cash, it has to be accepted because that's a legal type of currency. Okay. So let's talk about the type of data set that we'll be working today. So we'll start performing some basic feature engineering. And with feature engineering, it means identifying the variables of interest that we care about and perhaps transforming them, modifying them in a way that we can actually use them for our goals. Remember what the goal at hand is, right? Is to study the relationship between volatility and the average trading volume per day, okay? Second, calculate and interpret relevant summary statistics. And three, inspect the relationship between volatility and trading volume. I would like to emphasize the connection between starting to explore the data before you apply any type of statistical methodology. Why is that? Because we want to feel the data. I like to tell my students this, that before you start applying any type of instrument or modeling technique, regressions, and all the stuff, just start exploring the data, have an idea, have an intuition of what you're working with. Start summarizing them, because some of the data sets might not tell you anything at a first glance. And we will see that there are three different ways to summarize your data. The first one is by the use of summary statistics. The second one is by making tables, so summarizing the data in tabular form. And the third one is by using graphics. I cannot emphasize enough the importance of visual representation of data. Graphs are very, very important. They can tell you a big story about what's going on, provide the intuition, and motivate the type of analysis that you will be performing on your data. So let's start looking at the data. We have a CSV file. Remember, CSV stands for comma separated values or variables that include data for each of the following stocks. CSV files are very popular. Why is that? Because you can open them with a text editor and you will see all the numbers separated by a comma, and also in an Excel format. So they can be imported as a spreadsheet. So you have a very flexible data format. It can be read very easily by Python, can be read very easily by R, by MATLAB, by any type of software. It's one of the most common types of formats. So we have the 5 stocks that we were considering. All of them will be denoted with the abbreviation that is used actually on Bloomberg, on all the trading journals. Let me see what you're all saying on the chat. Joseph said, nobody forces you to buy gas with rubles. Yeah, although it seems like there are pressures right now that the countries that want to purchase gas from Russia will have to pay rubles. And Jay Horman says, what was feature engineering? Feature engineering, it means identifying the features of interest and perhaps transforming them so that they can be used for our goal, okay? Adrian, CSV plus R is match made in heaven, indeed. When you start doing read.csv and write.csv, you can communicate very easily, okay? Fabio, I have a question. How did data science handle the external facts that affect the stock prices? Oh, well, there is an entire literature about the impact of news on stock prices. You can build very fancy econometric models, for instance, where you incorporate the news effect. News usually come up as shocks to the market. Like, you know, when there is a new announcement, the markets react. Something bad happens, the markets start fearing and they start selling because they're afraid of losing value. And that's typically when the market prices go down. And there are models, of course, that incorporate this type of information, for instance, using heavy tails. So allowing margin of errors for any type of estimate that can take into account very extreme events. There is a big literature, but you know, we will talk more about it when we'll enter into business analytics and forecasting and so on. So these are the symbols that we use to denote these 5 stocks: D for the Dominion, EXC for Exelon, NEE for Nextira, SO for Southern, and DUK for Duke Energy. And these are the variables that we have in this particular stock. We have the date. The date is a standard date. Remember that data can present itself under different formats. They can be dates, they can be categorical data. Categorical data is when there is something descriptive. In this case, an indicator that tells you, for instance, which stock is that would be a categorical variable. Or any type of quality variable that represents, let's say, the level of risk for a particular stock. And then many variables are, of course, quantitative, and quantitative variable can be discrete, can be continuous, can be ordinary. So there are many different types of numerical data. Then we have open, and is the stock opening price of the day. As we mentioned, during the day, the value of a stock can change a lot because many things can happen. The interest of the investors can change. There are a variety of scenarios that impact the price. Every day at the beginning, when the markets open, there is an opening price for all the anything that is traded in that particular market, and it might be very different from the closing price of the previous day. Because many things might have happened when the markets were closed. This is particularly true after the weekend. There is a so-called weekend effect because, you know, during the weekend the markets are closed, so there is always an adjustment to reflect the ways that the world has changed while the markets were closed. Then we have high, which is the highest observed stock price for that specific day. Then we have low, which is the lowest observed price for that specific day. Then we have close, the stock closing price of the day that we are talking about, and then the volume of the stock traded over that day. So that's the value of all the stocks of that particular type that were traded in that day. And of course, you know, typically these are very large numbers. Okay, let's start taking a look at a portion of the data. One way to start summarizing the data is displaying the first rows. Okay, the first rows, and you see, okay, what's going on? Does the data set look to be complete, or there are gaps? One thing that I like to do now, in this particular case, we have information, we don't have missing values. Finance data nowadays tend to be very high quality, just because it's so important to model this data that the data collection systems are very, very accurate. We will see in other data sets that there are missing values, there are holes, and we will have to learn on how to deal with that, okay? So let's start looking at the data from Dominion Energy. And again, these are data from the New York Stock Exchange under the symbol D, and these are the first 10 rows of our data set. Notice that we have the first column is in date format, and the other variables are all quantitative variables, right? So let's say on on the 1st of July of 2014, and notice that these data are clearly from the US, because you see that the month is listed before the day. Okay, so don't be confused. This is not the 7th of January, this is July 1st. Okay, so the opening price was 63.406. This is the highest value, 63.48. The low was 62.61, and the close was 63.077. Notice that during the day, overall, this particular stock, the Dominion Energy stock, has lost some of its value. And here you have the total value of the transaction, which is equivalent to $3,626,031. And then you have information for the second, the third. Notice, where are the fourth, the fifth, and the sixth? Well, July 4th, we know that is the 4th of July is a national holiday in the US, and that's why 4th of July is not there. Probably in 2014, the 4th of July was a Friday, and then that's why also the 5th and the 6th are missing. Okay. All right. Sometimes we do not have all the variables that we need for our analysis out of the box, and that's where feature engineering comes into play. Somebody, okay, this is actually an interesting question. How the low value could be larger than the close? Well, it's possible that this was the final value, but it was not traded. It's perfectly possible that it closed at a time when there was not trading activity. The variable volume is issued in dollars, Marcela. Why the opening price doesn't match the closing price for the previous day? Because when the markets are closed, as I was mentioning, the value might have changed in the eyes of the investors. When the markets open, there will be a new bid and a new ask price. What is the bid and ask? So as in any market, there is a price that investors want to pay and the price that the sellers want to sell, okay? And basically the trading price will end up being a compromise between the bid and the ask price, okay? All right, so sometimes we don't have all the variables that we need, or in the way that we need, in the format that we need, and that's why we need to transform it. Jorge, how can I determine the volatility of the stock? We are getting there. This is actually part of today's class. We'll learn how to calculate volatility in this particular case, okay? And that's part of the questions that we want to ask. So let's start adding a new column that indicates the name of the stock that we are referring to. And in this case, these rows refer to the Dominion Energy, so we are going to add the letter D. So this column will be an example of a categorical variable, okay? Now, there is a variable volume that is a bit difficult to read just because you have to go and count the digit. You notice that when I went to check, I needed to count and say, okay, are these millions or hundreds of thousands and so on. So we create a new variable, volume millions, to make it work. So we basically divide by the total. And notice that the volume, sometimes it can come up with the total number of shares. A lot of time is in dollars. And there are also other type of indicators to indicate volume. In this case, it's the millions of shares. So it's not the, if we divide by 1 million, we will have the millions of shares that were traded, okay? So the formula will be volume divided by 1 million, okay? So, and here we go. So we started with the standard data set that contained data, open, high, low, close, and volume, the symbol that denotes the share, and then the volume in millions, the number of shares that were actually traded. And in this sense, we can have an idea of how many transactions there were. Keep in mind that the number, why sometimes the volume is expressed in dollars, because sometimes you have companies that have very different value for each share. So the number of shares might not be telling you the full story about how big the transactions were, okay? So that's why you need to, ideally you would like to have both. Now, typically what you can do is you can create an approximate value. If you do not have, let's say, the total volume in dollars, what you can do, you can create an approximate value by taking the number of shares that were traded by an average price, okay? Positive volume means that stocks were purchased. Well, of course, yeah. And if they were purchased, they were sold. So it means the number of stocks that were traded. So no, it's not possible to have negative volume, Julio, because for any buyer there is always a seller, and for any seller there is always a buyer. It is possible, though, that a particular stock does not get traded at all, and then the volume is, of course, zero. Okay, so zero is the minimum value of volume that you can observe. Okay. So we want to study the relationship between volatility and volume. So we don't have volatility here. And volatility can be calculated in many different ways. Volatility can be calculated as a variance. We want something that measures the spread, okay, how much the price has changed. However, here we do not have all the information to calculate a variance, let's say, because for that, you will need to have all the trades, all the prices for that particular day, okay? So we will have to look at an alternative measure of spread, an alternative measure of variability, okay? We could look, for instance, at the, let's start first of all defining what the returns are, okay? We can say that the daily returns are defined as the percentage gain or loss in a day compared to the previous day. So the return, let's say, on a particular day will be equal to the closing day, let's say today, minus the closing date yesterday divided by the closing date yesterday. Or manipulating the formula, we will have the ratio of the closing value today divided by the closing price yesterday minus 1. So when the returns are positive, it means that the closing price today was higher than the closing price yesterday. When it's negative, it means that the stock has lost some value, so you have a negative return. So it is possible to have positive returns and negative returns, okay? So if you buy a house and you try to sell it tomorrow, if the price goes up, you're gonna make a profit. If you're gonna try to sell it and the price that you get is lower, you're gonna make a loss. Carlos, is return equal to volatility? No. We are just starting to define returns, and we're going to get to volatility. It's an important definition, though, that we want to give. And so the volatility is connected to the idea of returns, but is not exactly the same thing. So let's call returns what they really are, which is the percentage change in an interval of time. Remember, there is a particular case where returns can be zero, and it's essentially when the price does not change. Very rare that this actually happens. So exercise number 1, if just to fix ideas, imagine a day in which the price of the shares at the close was lower than at the previous day, which the following will be true: return equal to 0, greater than 0, less than 0, or return equal to 1. it will be C, return less than 0. Very clear. Since the fraction term in the definition of return will be less than 1, because the value today is less, return will be less than 0, and so we will have a negative return. So we can create a new column that is called close previous to help us remember the closing price of the previous day, and another one, return, that corresponds to return. So we will see that by comparing the returns and the closing prices and how much they change, we'll get a measure of volatility. Okay? So now we have two new columns, close previous and return. So who can tell me why we have on the first row, we have this symbol here that means not a number? Why is that? Because we don't have data before July 1st, right? Exactly. Excellent. So for the 8th of July, the closing price was 61.296, and the closing price of the previous day was 61.38, which means that the return for July 8 was 0.4% approximately. Now, let's use this idea of modifying the variables to create a measure of volatility. So returns are connected to the idea of volatility, but the idea of volatility has more to do with the spread of how much variability there is in prices, okay? And we call it vol stat, okay? Which is basically a statistics, a summary statistics for volatility. And we take the range of the price for each day, which is high minus low, so the highest price minus the lowest price, and we divide by the opening price. So if we start at a given value, and that's the opening price, and we put on the numerator the spread of that particular stock on that specific day, we have a measure of volatility because we know with respect to the starting price how much change there has been. And it will be, of course, it will be a percentage change, right? Because we have all of this, both the numerator and the denominator will be measured in dollars, of course. And so we will get a percentage type of change. We divide by David. We divide by the open price because we want to have a comparison with something that is given at the beginning of the observation period. Okay, and this metric captures the movement on that specific day, which is exactly the idea of volatility that we are trying to capture. So we divide by open to normalize the results so that we get a number that is comparable across days, right? Because otherwise we might end up with, if we don't know where the starting point is, it will be harder to compare. Julian is asking, volatility is always positive. Yes, volatility is defined in this way is always positive because we are subtracting the higher value minus the lowest. So the numerator is always positive and the opening price, of course, is always positive. Okay, so we are adding yet another column here that indicates the variability, the volatility for that specific day, right? So now let's start exploring our data. So we performed some basic feature engineering. Danielle, what volatility value means that the stock is volatile? Yes, volatile means that can change and so on. Normalize means that we are dividing by a particular number. So for instance, when you want to, imagine that you want to compare the income of two different cities. And and you say, well, city one makes, I don't know, $10 million a year, and city two makes $20 million a year. And you say, well, are they the same size? Well, one way to normalize them would be by dividing by the population. So in that way, you have things that are more comparable. So normalization means that you want to have a metric that is comparable, because here we have things that are changing. We have prices that are changing from day to day, and we have different stocks. So we want to have a metric that is as comparable as possible, okay? Manuel says, what happens if I use the high values minus low divided by the close value? Is that a useful metric? I would say that it's a little bit less useful because it's using the last value as the normalizing factor instead of the first one. So it really depends on what your goals are. Since you are looking at the story for the entire day, you probably want to compare it with the initial condition rather than with the end condition. So it might have its usefulness, but I would recommend always normalizing with respect with something that has already happened, okay? Because also there might be last minute news that impact the closing value. So you are comparing the past, everything that has happened, with something that might be influenced by the last minute changes, okay? All right, so let's start with summarizing our data. Our data can be very hard to summarize because you have, not hard to summarize, can be hard to understand if we just look at the raw values, right? Right now we are just looking at 10 columns, but in these data sets there are many, in this data set there are many more rows and columns. And so we want to kind of see, okay, at a glance, what are some of the useful summary statistics? So let's start with a different type of examples just to fix ideas. Imagine the following situation. You have a list of ages taken from a survey you conducted among your friends. So you want to say, okay, I have friends of very different ages, and I want to describe the age of my friends with something that is a little bit easier to interpret rather than just listing all of them. I can see here that, well, I have somebody that is 21, 30, and I can arrange them in increasing order. Notice that this particular person has friends of a variety of ages, okay? And there are some ages that seem to be more represented, but you know, the youngest person is 21, the oldest person is 70. Notice that there are a lot of people in their 40s. So, you know, probably we can speculate that the person that is conducting the survey is probably has an age that is in that particular bracket. Jaime, with the mean and variance, of course, mean and variance are some of the classic ways that we want to summarize our data. When I ask my students, what is the first indicator that if you could describe your data with one number, what would that number be? And everybody answers the mean. One, can we represent the data into a histogram? You must be seeing the future because we are going to be talking about histograms today, okay? So imagine that we want to categorize the ages by groups, okay? Imagine that you have different crowds of friends that you know, that belong to different groups, okay? So you might say, okay, how many friends I have in their 20s? And I say one, right? Because there is just one observation that is between 20 and 29. What about in their 30s? Well, there is somebody that is 30 and somebody that is 35, two people. 40 and 49, 7. Then there is nobody in the 50s or in the 60s, and there is one person in the 70s, okay? So this tabular form of representing the data is already more readable because you really decrease the dimensionality of your data set. Now, notice that this will not change in size, this table will not change considerably if you had many more friends, just because you are defining the categories for the ages in such a way that you are covering almost all possible ages. Yeah, sure, you might add to have, you might want to add some other rows if you had somebody in their 80s or somebody even younger, and so on. And Jaime is saying, could we just skip the 0 groups? Technically, yes, you could definitely do that. Typically, though, we use this type of information to create histograms. And in the histogram, we need to have basically on the x-axis all the values. You don't want to break the x-axis line, okay? Eliana, ordinal variables. Yes, indeed. In this case, the groups in itself, in their sense, they are ordinal variables because they are going in order. So by doing this, we are starting to characterize the distribution of the data. What is the distribution of the data? The distribution informs us of what ranges of data are more popular. That is, where you have most of your observations. And that's the distribution of the data means that which parts of all the possible values are the most likely to occur. So if you would have to pick at random one of your friends, you will have a very high chance to select at random somebody that is on their 40s. You will have much lower chance to select somebody on their 30s or in their 20s. And you will have a 0 chance of selecting somebody on their 50s or in the 60s, because in this case, there is nobody. Okay? Now, if we take this table and we create a graph with it, we have the famous histogram. And this is the histogram for ages. Notice that we created these bins, so these intervals between 20 and 30, 30 and 40, 40 and 50, and so on and so forth. And on the y-axis, we have the so-called absolute frequency. The absolute frequency means how many of them you have. You have one friend on their 20s, 2 friends on their 30s, 7 friends on their 40s, and 1 friend on their 70s. Okay? David, my friend in 779 range, my grandma. Say hola to abuelita. The reason why I call this frequency absolute frequencies is because we are actually counting the number of cases that are occurring. If there is an absolute frequency, there is also a relative frequency. What would be a relative frequency in this case? You can calculate the relative frequency by taking the absolute frequency and divide by the total of your observations. In this case, how many you have? You have 11 observations. So the relative frequency of 40-year-old people will be 7 divided by 11, which is about 60-something%. So that's a big portion of your friends. Okay. And notice that the way that you define the bins is totally your choice. You could have defined the bins differently. You could have taken between 50 and 55, 55 and 60, and so on, with ranges of 5. Typically, though, you want to keep the size of the bins the same. So in this case, we chose 10, but it could have been 5, it could have been 4, it could have been 3, it could have been 1, and so on. Okay. All right. Now, keep in mind that age, in this case, is defined as an approximation of the age. Age is technically, somebody, Guillermo, variables are discrete. In this case, the age variable is considered continuous just because you can measure the age with decimals. In this case, though, we only have it in integers, so it's an approximation, and we are discretizing it further by creating some ranges of 10 years. Okay. So if we take a different bin size, we see now if the spread of the bin is 5 instead of 10, we still have a histogram of the same data set, however, looks different, right? It has some features in common, but it also has some differences, right? So notice that the shape seems to be somewhat similar, but it's still a viable histogram. The ideal bin, how do you choose? Well, it really depends on you, but sometimes there is an ideal bin that will allow you to have a histogram that is reasonably populated and readable. There are different ways to define this, and the library pandas provides some sensible defaults that work in most cases. And then, of course, you can go and alter the defaults to suit your needs. Okay. Now, we understood the way that it works for ages. Let's apply it to our data set. Okay. For the volume in millions. Okay. And notice that our data goes between less than a million, right, to about 12 million, right? So, you know, the volume is very large. And this is the histogram that we have for our variable of interest. Notice that there is a long tail on the right. So we definitely have a distribution. We say that this distribution is skewed to the right. That means that there are a lot of variables that are on the right that are, let's say, far away from where the most of the mass of the distribution is. So let's interpret the histogram. What are we looking at? The variable ranges between less than 1 and about 12, right? Almost 12. These are in millions of shares that are traded. On most days, the traded volume is higher than 1 million, but lower than 4 million. So this is the number of days that we are looking at, right? The number of instances for which it occurs, right? So this is the most popular interval where we expect to see. So it's more than 1 and lower than 4. This is the part of the distribution where most of the observations are. Therefore, a typical day would be a day in which the number of traded shares is between those two numbers. There are few days where the volume is higher than 6 million. Those are days of high activity, okay? So the distribution in this case is called right skewed. Now let's look at the histogram for the opening price for the Dominion Energy. And by now you know already how to interpret this. Notice that the opening price, of course, is in US dollars. Okay, for that particular share, for one share, this is the value per share of Dominion. And we see what? We see that the price goes between little less than 60 and above 80, right? And most likely value will be, let's say, between 62 and 67. Okay, we also have a distribution here that is, let's say, less spiky than in this particular case, and it looks more boxy. Notice that it does not have a long tail like the previous one, right? And it looks to be a little bit skewed to the right. That is correct, because you can see that there is a little bit of tail here, but it's not as extreme as in the previous case, okay? While creating frequency tables and plotting them is useful, we sometimes want an even more summarized view of our data. So for this reason, we can calculate summary statistics. And some of you were already mentioning the mean and the variance, but there are many more. There is the minimum, the maximum of the data, or the median, okay? So let's start indicating on the graph the minimum and the maximum price, okay? For this particular data set, the minimum price was 57.77, which is right here. Alvaro, with histograms, we can start seeing if the distribution is normal, definitely. And we see what the normal distribution is. You know, it's a big topic, and, you know, we'll see it a little bit later. The famous Gaussian distribution, or normal, the bell curved density distribution. And the maximum is 81.55. Exercise 3, the range of the variable is a number that gives you an idea of how spread your data is. And you can obtain it by calculating the maximum minus the minimum of your variable. And we saw it appearing in the measure of the volatility that we calculated before. It was in the numerator for that specific day. Of course, we can do it for all the days, calculating the maximum value and the minimum value for the closing time. And we will have the spread of the closing. So the spread can mean many things depending on the variables that you are considering. So the spread of the closing will be equal to 81.55 minus 57.77, which in this case, the result is, of course, 23.78. So as much as the minimum and the maximum give you important information about the shape of your distribution, they are often not enough, right? Because in some cases we have symmetric distributions, in other cases we have skewed distribution. So knowing the most extreme values doesn't really tell you what happens most of the times. It only tells you what happens on the extremes. The most common indicator of center, it's called a measure of center because it tells you where more or less the data is centered. And you see that one of them is the mean, the other one is the median. The first one is called the mean, and the arithmetic mean is calculated using this simple formula. So typically the arithmetic mean, or simply the mean, when the mean is, when you talk about the mean, we typically assume there is the arithmetic mean. There are other types of mean. There is the geometric mean, there is the harmonic mean, and so on. But in this case, we are talking about the arithmetic mean. That means you take the sum of all your observations and you divide by the number of observations that you have. You learned how to calculate means very early in your life. When you have to calculate your grade in a particular course, for instance, and your teacher is averaging your grades, that's a particular example of the mean. Or when you're keeping track of the calories that you burn in a day, or the number of miles that you drive with your car. For instance, if you want to know the average kilometers that you drove in a particular year per day, you take the total number of kilometers that you drove and you divide by the number of days, right? David, mean equal to average? Yes. And so it's indicated with X bar. In the numerator, we have the symbol, the C letter, it's a Greek letter called sigma. It means you are summing all the observations that go from 1 to n. With n, you indicate the total number of observations you have. So if you have 10 numbers, n is going to be equal to 10. AI here is indicating each one of the observations. I is just an index. So it means observation 1, observation 2, and so on. So what we are saying is we are summing up all your observations, and then we are dividing by how many observations you have. Okay? Another way to write it, which would be a little bit more consuming if you were using pencil and papers, you could write it as A1 plus A2 plus A3 plus A4. Then you get tired and you add the suspension points plus AN. AN means your last observations, and then you divide by N. So if we want to indicate in the histogram the where the mean is, we can just draw a vertical line where the mean is. In this case, the mean is 69.12, okay? And the mean, you can tell there is a measure of center because it falls right, more or less in the middle of the histogram. It's not always in the middle. We'll see that, you know, when the distribution is skewed, it's not going to be exactly in the middle, but it's going to be somewhere, you know, in the central part of the. Andres, what's the difference between the mean and the sample mean? So the mean is a general concept. There are different types of mean. There is the population mean that considers all the variables that are measured. In this case, we can consider this is the population of our data, but imagine that you have a subset of the data, okay, that you are collecting. Then in that case, you have a sample mean. So typically we deal with samples because we do not know the entire population. For instance, if we want to know the income of a particular city, the government has the population, so it has the true mean. But if we want to calculate, let's say, the average income of our friends will be a sample of the total population. And so, and it really depends on how you define the population of interest, okay? The problem with the mean is that if you have skewed data, then the mean might not be a good indicator of center. It's not too robust, especially if your sample size is small. The mean tends to be very sensitive to extreme observations. And you see that specifically with smaller data sets. In this case, the data set is large enough, and so probably you can get away with it. A more robust measure of center is the so-called median. The median is the value so that 50% of the observations are larger and 50% observations are smaller, right? So for instance, if we go back to the age example, what would be the median, right? So you have 11 friends. The median would be the central value so that you will have 5 older friends and 5 younger friends. In this case, the median would be exactly 45. 45 would be the median friend. 5 friends are younger than this friend, and 5 friends are older, okay? So that's the concept of the median. And yes, you know, to calculate the median in a simple way, we need to order the data so we can tell which ones are younger and which ones are older. So in this case, we see that the median and the mean are reasonably close, right? Notice though that the median is indicated in green, so it's a little lower than the mean, right? So the median is 68.59 and the mean is 69.12. That denotes that the distribution is slightly skewed to the right, as we had already seen with our visual interpretation. Now let's go back to the volume data. In this case, we have a very skewed distribution, okay? Which of the following is true about this distribution? The mean and the median will coincide, the mean will be greater than the median, or the mean will be less than the median. Given what we have said of the relationship between mean and median. So Marlon says C. Who agrees with Marlon? All right, so there are some C's, so that the mean will be less than the median, but the consensus seems to be on B. The mean will be greater than the median, because you have observations that are on the right tail. So, and in fact, the answer is that the mean will be greater than the median, and we can see that graphically, and we can see that the mean is 2.75 and the median is 2.52. When you have a symmetric distribution, the mean and the median tend to be very, very close together, okay? In this case, the data set is still large. It's so large that the impact on the mean is still, that the mean is still decently close. So, you know, in this case, although the distribution is skewed, you do not see a huge difference between mean and median. However, you do see that the mean is larger, okay? How much is very close? Well, sometimes it's a qualitative type of judgment. Here we are talking about fractions of a dollar, right? So 2.75, 2.52, we're talking about 23 cents of difference, which of course, if you're trading large volumes can make a lot of difference. But you would see that if you collect a sample of this data, okay, you might observe much bigger discrepancy, okay? All right. So as I was mentioning, the mean is more sensitive to outliers than the median is. So a very large number or a very small number will impact the mean a lot. It will not impact the median, quite honestly, because the median is only looking at the order. The median is a so-called order statistics, because it's only looking at the way that the observations are ordered. There are two additional summary statistics that we want to mention. The first one is the mode. The mode is simply the most popular value that you are observing, or the specific bean that you are observing. In this case, we see that the most common bean is between 2 and 3, right? So we can say that the mode is between 2 and 3, right? And when we have a single mode, like in this case, when we have a single peak, okay, we say that the distribution is unimodal. A distribution can have more than one mode, and so it's called multimodal. If it has two modes, it's called bimodal, okay? And you can see this often, but not for volume, but for other types of observations. So between 2 and 3, well, notice that here there are the way that the histogram is plotted here. Some of the beams are skewed a little bit, and so yeah, they are not exactly the same, because they are trying to accommodate the minimum and the maximum. The way that most softwares actually like to draw histograms are more of this type, like the one that we have seen for ages, when they have the same size. All right, so the other variable, summary statistics that are worth mentioning are the quantiles. The quantiles are they divide the data sets into percentage. So the median is the 50th quantile. That means the 50th percentile, that leaves 50% of the observation to the left and 50% observations to the right. Let's say the 90th percentile, it means that if you score in the 90th percentile, let's say, on a particular test, it means that you have done better than 90% of the participants and worse than the 10% of the participants. So you did pretty well, okay? And so the quantiles are very important. So the median is the most classical example of a quantile. And here we have the distribution of the closed column. Try to imagine where the line should be for these quantiles. At 0, of course, the 0 quantile would be right here, right? What about for 25th? You will have to look about 25th% of the observations. So probably it's going to be about here. The median, we said that it was here. The 75th percentile would be about here. And the 100% would be here, okay? So here we are saying that 25% of observations are between the minimum value and about 64. Between 64 and 68, you have the next 25%. Then between 68 and 74 point something, you will have the next 25%, and so on. Notice that since you have more data here, this beam tends to be smaller, okay? So the inner 3 quartiles are somewhat squeezed around the middle of the distribution. That is, the quantiles are not evenly spaced along the horizontal axis. Now, let's visualize the relationship between the shape of a histogram and its summary statistics. Run the cell below and open the link that appears. Play around with the parameters and share with the class everything you find interesting. Every time that you change the parameter, a distribution of random numbers is generated and its mean and quantiles are computed. So I will let you run the applet, and you will have to run it. And you will see that there will be a link that will take you to an applet. And you can increase the skewness to the left. And we'll see a data generating process. Notice that created a big curve, right? And notice how the first quartile is so skewed to the right, right? You have a distribution that's skewed to the left, but the first quartile means 1/4 of the data. So a 25th percentile. And Jonathan, is there any other graph to represent the quartiles? Of course, there are many of them. For instance, you can use the famous box plot. We will learn it in another case. If you create a distribution that is heavily skewed to the right, you notice that 25th percentile tends to be on the left side, and so on. Some of you are having some errors, but the TS will help you debugging your example. And let's go back. You can play a little bit more later with it. Okay. It's important now that we reconnect to the original question. Let's now work with the complete data set. We have data for all 5 stocks in a single table. So we have the summary statistics, how many days we are considering, the mean, the standard deviation, the minimum. We'll see what the standard deviation is. We have not defined it here. The minimum, the 3 quartiles, and the maximum. So what we can see is that the volatility level on any given day can change widely, right? Because we are looking at values that are changing quite a bit. We have from a minimum of 0.02% to about 4%, which is several folds of magnitude larger, okay? Which is, again, it's a substantial amount. What are some of the insights that we can draw from this information? So the highest volatility seems to be the volatility associated to EXC. Notice that this is the largest value, the largest average value. And we might want to go and check how this volatility now compares to the average daily trading volume, right? And that's the question that we wanted to check. So now let's label data points as high volatility or low volatility. Let's identify periods or days where the volatility is high and where volatility is low. And we can define this on the basis of a threshold. What is a threshold? What is a value? Would be a value of interest that we are using to compare it. And this could be the median, let's say the 50th percentile. So all the values that are below the median will be low volatility. Values that are larger than the median will be high volatility. And so we will have an additional column that will tell us about the volume level, right? So in this way, what we are doing is saying we are looking at the volume levels compared to the median and compare in whether they are larger or so. That is, we want to see what is the effect of high volatility or low volatility on the volume. So let's group by symbol and volume level and take a look at the average value of volume in millions for the high and low volatility groups. So for the Dominion Energy, the volume will be 3.12 when the volatility is high. And when the volatility is low, the volume will be 2.3. And notice that this is something that we are observing for all of them. That is, when there is high volatility, there is also higher volume. So there is more trading, so the price changes more. How do we calculate the threshold? In this case, we just decided that the median was going to be our threshold. Carlos was asking. So the pattern that we are noticing is that higher volatility days tend to have higher daily trading volume. The pattern is consistent across all the 5 symbols. So we found a relationship, at least at a descriptive level, that whenever there is high volatility, there is also high trading volume. This is not the only way to investigate the relationship between volatility and volume, but it's one of them. Yes, speculators appear when volatility is high. Very true. When it's speculators are those investors that operate in the short term to try to make short-term gains. That is, they try to take advantage when the prices are low to and there is a lot of activity, the prices go higher, and then they start selling. So there is a lot of transactions in those periods of time. Marcella, does the daily trading volume have any relationship with the number of shares sold, bought in a single transactions? Would that be of our interest? Indeed. That's also a big question, because of course now the number of shares will depend on the price, and the type of transactions that happens, of course, that are also important, because you might be interested in the average value of the transactions. So is it mostly small investors, or is it bigger investors that are acting on the market? So there are different things, and it's a complex topic, of course. And some of these relationships are not always, they don't go always one way. There are a lot of time-sensitive issues. There are market-specific type of issues, okay? So let's now look, since we have a couple of minutes, although this was kind of like, a simple case, but a lot of material to cover, let's plot volatility across time, okay? This is a so-called time series plot. What is a time series plot? A time series plot is a plot where on the x-axis you have time, and on the y-axis you have the variable of interest, that in this case is nothing but your measure of volatility that we had defined. And notice that we are using a different color for each one of the for the different stocks. Diego, how the threshold was defined? We chose the median. So the median to determine what high volatility was. So values above the median were values above the threshold, so they were considered high volatility. Values below the median were below the threshold, and they were considered low. Is that clear? I saw the people that were asking me. We noticed that the maximum volatility was right here. So this was a period where the volatility was actually high. These are daily data, right? And we can see that there are periods of high volatility. They seem to be followed by days of high volatility. This is a feature of stock market data. And that is that when volatility is high, chances are that at the next time point, there is still going to be high, there is still going to be activity. We say that in those moments when there are a lot of transactions, and so we say that the market is bullish, and when it's lower, we say that the market is bearish. So the bull and the bear are the two symbols for the financial markets. So yeah, it's actually, that's the question that the exercise was asking you. We notice that periods of high volatility tend to cluster together, to clump together. That is, period of high volatility, they are not uniform, but they tend to happen close by together. So for instance, this is a period of high volatility, this is a period of low volatility. We say that there is autocorrelation in the volatility. Jaime says, difficult to forecast because the variances change, of course. And a lot of models actually do not try to predict returns. They try to predict volatility itself. There also seems to be some kind of cyclical movement each year. This might be worth investigating further. Well, that can be related to the availability of natural resources, to situations in the market, to demand. Demand for energy changes during the year. There are times where the energy consumption goes up and when it goes down, depending on the area that you are considering. In the United States, we are in the Northern Hemisphere. Of course, there is higher consumption, for instance, for gas during the winter than there is during the summer, and there is higher consumption of power during the summer just because of the higher use of air conditioning. Here in the US, people use a lot of air conditioning, but there are many more issues that need to be considered. So we can, if we plot, let's say, by calendar month, so if we have on the x-axis the months, and we have the average volatility, we can see that around June, the volatility seems to be lower, and during the winter seems to be higher. And this seems to be the case for pretty much all of the finally, identify the months that seems to have the highest volatility. Well, it seems that February has clear sign, and perhaps December as well, right? And overall seems to be an increase in volatility in September, March period, and a decrease in the late spring. And so in conclusion, we have to have a short break, but we reconnect further to look more in detail at these examples. We identified a number of interesting patterns that connect volatility and trading volume. We noticed that the trading volume was higher in days of higher volatility. And we also noticed that just by plotting the volatility over time, that days of high volatility seems to be clustered together, and then there are clusters of days of low volatility. And that's a very important feature of financial market data. How would that graph be represented if they were missing data? Weather data, for example. Natalia, excellent question. Sometimes the time series plots get interrupted and you see some gaps. So you do not cancel anything from the x-axis, you just leave a gap where you don't have the observations. There are a lot of statistical methods actually to interpolate data when there are missing data, particularly in time series, just because you can use the information contained in the data structure to interpolate the data. Miguel, should we replace NAN with mean or zero values? That's a big topic. It really depends. For the first case, now the NAN that we saw before, they were not missing. They were just not available because they were variables that we just constructed. It really depends. There are different strategies for data imputation. Some of them, you actually try to impute different values and then see how your results change. So it's a big topic. Okay, so I don't want to take time off your break. I don't want you to get too tired, but we are going to reconnect in 15 minutes break. If I'm not, Monica, let me know if I'm saying something inaccurate. But I think we have to have a break between now and then resume in 15 minutes. All right.
Thank you for Professor Cavino. Okay, let's take a 15-minute break.
All right. Hi, Oscar.
Hi, Professor.
Thank you, everybody. I'll see you very soon.